Mark Matthews of Bank Julius Baer is joining us right now to take us through what he's making of things now. Mark, great to have you with us here. Thank you very much. I don't know if we read out a little bit from what Lawrence Blanco of CLSA, of course, he's a technician, technical analyst. He's, of course, cautioning. He says that, well, things are maybe a little too stretched here. How would you kind of address that question, here and now question, as far as markets after all these games go?
Well, I think technical analysis is very important. We as a bank pay a lot of attention to it. We have an entire research team dedicated to it. And to me, the most important thing that's happened over the last couple of months is the breadth of the market has staged a turnaround, which has really only happened, as far as we can tell, I think 6 times in the last 30 plus years. So there are different ways you can study breadth, but to cite just one, the ratio of S&P 500 stocks trading above their 200-day moving average was less than 10% back in June, and it's over 90% today. So that's an amazing turnaround. And if you look at the previous times that happened, as I said, there were, I think, 6, as memory serves me right. If it wasn't 6, it was 8. Anyway, it's less than 10. The S&P was up all of those times over the next 3 months, over the next 6 months, over the next 12 months. So I agree with Lawrence Blanco that, the technicals are looking strong.
Well, okay, the technicals are looking strong. But Mark, the fear is, and I guess that's the fear in every big bull market, right? That how much is too much? And the run-up has been pretty sharp. I mean, for the Indian markets, it's been a gain of 12% in just 1 month. Do you think a pause is on the cards? Or should one just ride this rally, even if you've joined in late?
Well, you might know that the 200-day moving average is another important technical indicator for momentum. And pretty much all of the major indices are bumping up against it. High-yield bonds are approaching their 200-day moving average. The S&P and the NASDAQ are just a fraction below it. The Dow Jones and the Russell 2000, which is the small caps in the United States, have actually just broken through their 200-day moving averages. So this is a momentum indicator. It's showing you that, I mean, if the indices trade above their 200-day moving average, generally they have good positive momentum. I mean, given that only 2 of the major ones have broken above and still there's a bunch that are below, I think we just have to wait and see. In the short term, anything can happen. But I go back to what I said earlier about this, what technical analysts call breadth thrust, B-R-E-A-D-T-H, breadth thrust, which has been very strong over the summer, and historically has produced favorable results over the next 3 to 12 months.
Okay, Mark, hi, good morning. So now moving away from the technicals, fundamentally though, how are things looking? Because there's still a debate, at least in the US, that whether it still is a bear market rally or start of a fresh bull run. Your thoughts on what kind of market we are in?
Well, this is the funny thing about markets, is that frankly, we should not be having a breadth thrust. Things look pretty bad. We still have very high inflation. In America, you have very strong wage growth, which should lead to greater inflation. And you've got unionization of stores and warehouses of major companies like Amazon and Apple and Starbucks and Trader Joe's, which infers more wage price pressure. So it's the kind of thing that we'll know in retrospect why the market's breadth has improved so dramatically. Right now, we don't. My best guess is that actually we will be in a Goldilocks scenario. We are in a Goldilocks scenario. We just don't know it now. And what I mean by that is inflation will come down, but we won't go into a recession.
And we won't go into restrictive monetary policy as well, right? That's the third leg.
Yes, that's right. So I believe the Fed has hiked by 225 basis points so far since March. We're looking for about 300 to 350 basis points of hikes in this current cycle, which means they're more than halfway done. And between 300 and 350, I guess it's data dependent. I don't think we have a strong view on which one. But suffice it to say, we don't think even 350 basis points of rate hikes would be enough to cause a recession because the labor market is so strong.
Okay. But I guess what really stayed with us, at least stayed with me in the conversation so far, is you saying that we are in a Goldilocks scenario, and perhaps we'll only realize that a little later, right, when you look back and map the gains. So for an Indian investor, just coming back to the fact you said technicals are strong, we're in a Goldilocks scenario, and even the macros are positive across the world. If this bull rally continues, where do you see the preferences now, Mark, for an investor in India? Will it be towards the traditional banks, which have done exceptionally well? Will you look towards the IT space, which perhaps is not doing as well, maybe because of the impending recession in the US? Where would your preferences lie?
Very much in the banks, and I know that's a consensus view, but it just makes sense that with the NPAs having been written down to low levels and the formalization of the economy, we're really starting to see driving economic growth. And the startups, the digitalization of the economy, I think that banks will be the biggest beneficiaries of this because there is a capex cycle which will be very robust. I also might add reallocation of manufacturing away from China. And India, of course, has this huge domestic market to cater to. And foreign companies, in many instances, in many sectors, can now have 100% owning of the company that's operating in India. So I put it all together, and I think that loans growth will be strong, and that's good for banks.
Mark, what's your view on what's happening in China? Because there's some fresh concerns emanating from there in terms of what's happening to the Chinese economy. If the government is hiding a lot of information, do you think that could have some bearings on how the market shape up from here?
Yeah, the economy is definitely weaker than the consensus had expected, and the policy loosening has not been as strong as the consensus had expected. And very simply, I think that for reasons that are unbeknownst to me, they have chosen to prioritize zero COVID over the economy. I don't really know why. But that's the way it is. And of course, a lot of people are hopeful that once the Communist Party Congress is out of the way in November, the restrictions will be lifted. But the senior positions, apart from the Secretary General and the presidency, those won't really be defined until around March of next year. So I wouldn't hold my breath. I think actually they are trying to create a system whereby there will just be constant testing of COVID. Like I think in most cities, everybody has to get a test every 72 hours to be able to go about their business. And I think they'll just keep doing that until they've got their own vaccines that work and they've rolled out and they've vaccinated enough people, by which time as well, the virus may have morphed into something even less dangerous than it is today. But it doesn't look good. I mean, it's very cheap. But there's so many other places in the world that are less complicated and more transparent. I don't see China taking airtime away from India anytime soon.
Okay, I guess that's the big question, right? Is India insulated from the global shocks, and will India continue its outperformance? On both those, what's your response?
Well, I remember 2008 making a terrible mistake because I believed that the Indian economy was protected from, the subprime mortgage crisis in America, which it was. As I recall, the Indian economy grew by over 5% in 2008, but the stock market went down over 50% because it's very linked to the rest of the world. And in a risk-off scenario, people will always have a home bias, and they will want to sell equities. So all I will say is I don't think we're looking at 2008. Meanwhile, to me, the dynamics in India are very favorable for the reasons I said before. So to me, actually, it looks like a very good market.
Okay, well, on that optimistic note, we'll let you go, Mark. Always a pleasure speaking with you. Thanks a lot for joining us on CNBC TV 18.